How to diversify your portfolio, a guide to safer investments. In today's unpredictable financial landscape, diversification is often hailed as a fundamental principle of investing. By spreading your investments across various asset classes and sectors, you can minimize risk and enhance the potential for returns. This video provides a comprehensive guide on how to effectively diversify your portfolio to ensure safer investments. Understanding diversification. What is diversification? Diversification is the practice of allocating investments among various financial instruments, industries, and other categories to reduce exposure to any single asset or risk. The core idea is that a diversified portfolio will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Why diversification matters? Risk reduction. By investing in a variety of assets, the negative performance of one investment can be offset by the positive performance of others. This balance helps to cushion the overall impact on your portfolio. Smoother returns. Diversification leads to more stable returns over time. It mitigates the volatility that can occur when relying on a single investment or asset class. Exposure to different markets. A diversified portfolio gives investors access to different sectors, regions, and asset classes, potentially capturing growth opportunities that they might otherwise miss. Increased opportunities. Diversification opens up a wider array of investment opportunities, allowing you to capitalize on emerging markets and industries. Steps to diversify your portfolio. 1. Assess your risk tolerance. Before diversifying, it's crucial to understand your risk tolerance. This is the level of risk you're willing to take with your investments based on factors like your financial goals, investment timeline, and personal comfort with market fluctuations. Conservative investors may prefer bonds and stable blue-chip stocks. Moderate investors might look for a balanced mix of stocks and bonds. Aggressive investors could focus more on growth stocks, real estate, or alternative investments. 2. Determine your investment goals. What are you hoping to achieve with your investments? Your goals will significantly influence your diversification strategy. Short-term goals. If you need access to your money in the near future, like buying a house or funding education, consider more conservative investments to protect your capital. Long-term goals. For retirement or long-term wealth accumulation, you might take on more risk with a larger allocation to stocks or alternative assets. 3. Spread across asset classes. The first step in diversification is to allocate your investments among different asset classes. Stocks. Consider a mix of large cap, mid cap, and small cap stocks, both domestic and international. Bonds. Include government bonds, municipal bonds, and corporate bonds. Vary the duration and credit quality. Real estate. Real estate investment trusts, REITs, can provide exposure to real estate without the need to own physical properties. Cash and cash equivalents. Keep some liquidity for emergencies or short-term needs, such as savings accounts or money market funds. Alternative investments. Explore commodities like gold or oil, cryptocurrencies, or collectibles. These can provide additional diversification benefits. 4. Diversify within asset classes. Don't just diversify across asset classes. Also consider diversifying within each class. For stocks, sector diversification. Invest in various sectors such as technology, healthcare, finance, and consumer goods to spread risk. Geographic diversification. Include international stocks from emerging markets and developed economies. For bonds, type diversification. Combine corporate bonds, government bonds, and high-yield bonds. Duration diversification. Invest in a mix of short-term, intermediate, and long-term bonds to manage interest rate risk. 5. Rebalance regularly. Over time, the performance of different assets in your portfolio will vary, leading to an imbalance. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation. Frequency. Decide how often you want to rebalance your portfolio. This could be annually, semi-annually, or quarterly. Methods. You could either sell off overperforming assets and reinvest in underperforming ones, or contribute new funds according to your desired allocation. 6. Utilize index funds and ETFs. Consider using index funds and exchange-traded funds, ETFs, as a cost-effective way to achieve diversification. Index funds. These mutual funds aim to replicate the performance of a specific index, providing instant diversification across all the stocks in that index. ETFs. Similar to index funds, ETFs trade like stocks on an exchange. They often have lower expense ratios and can provide exposure to specific sectors or strategies. 7. Monitor economic conditions and trends. Stay informed about economic conditions and market trends that could affect your portfolio. Macroeconomic indicators. Monitor interest rates, inflation, and employment data, as these can impact the performance of different asset classes. Sector performance. Keep an eye on sectors that are performing well and those that may be facing headwinds. This can inform your decisions about rebalancing and investment strategies. 8. Consider professional help. If managing a diversified portfolio seems overwhelming, consider seeking advice from a financial advisor. They can help you develop a tailored investment strategy based on your risk tolerance, goals, and financial situation. Common diversification mistakes to avoid. Over-diversification. While diversification is important, too much can lead to diminished returns. Avoid spreading yourself too thin across too many investments. Neglecting correlations. Not all diversifications are equal. Ensure that the assets you choose do not correlate too closely. For example, diversifying only among tech stocks doesn't truly reduce risk. Ignoring costs. Be mindful of transaction costs and management fees, especially with frequent trading or using multiple funds. Failing to adjust. Life changes, such as a new job, marriage, or retirement, can impact your financial situation and goals. Regularly review and adjust your portfolio accordingly. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.